Hi guys, and welcome to another week ahead video. Now in this week's video, our focus will turn to the US dollar. We've obviously seen massive price action to the downside for the dollar over the last 2 weeks, and all of that with very good reason. Now in this week's session, we do have the upcoming FOMC meeting and also some other focus points from the more global economy point of view that we do need to keep in mind for the US dollar. So join us now to the video to see exactly what things we're focusing on for the US dollar this week, and hopefully how we can trade some of them in this upcoming trading week as well. Taking a quick look at the baseline for the US dollar. Now the dollar has gone from a hated to a love to then a hated again currency, all just in a matter of a few short weeks. The recent push in the dollar index, especially this one in the last 2 weeks, has been fueled by the expectations of a faster economic recovery around the globe. Obviously not only in the US, but also other places like Europe, where the ECB announced a much bigger than expected increase to their pandemic QE program. Now, until recently, the hopes of a speedy economic recovery has been limited to stock markets, but recent positive developments in terms of supply and demand dynamics in the oil market did see commodity indexes also recover from their lows over the past 4 weeks. And this week, the bond market also joined in the party as investors started to dump traditional safe havens like bonds and rather opting for the more riskier assets like commodities. Now, even though markets has largely been discounting data recently, this week's NFP report got a lot of attention. The surprise in the NFP print was one for the record books. Now, it is true that NFP numbers can be volatile, but there's been a very few cases where both economists and analysts has been so wrong so much on a particular data point. Now, if we look at consensus versus the actual, we can see that consensus was for a contraction of another 8 million jobs, and that actually came in at a whopping 2.5 million jobs added in May. Looking at private payrolls, a same similar jump to the upside, as well as unemployment rate coming in much lower than expected at 13.3 versus expectations of moving up to 19.8 from 14.7. So the beat was so big that it left me thinking for a second that the Bureau of Labor Statistics might have forgotten to add a minus to that initial 2.5 million, just because the size was so big of a jump to the upside. Now, importantly, we always need to look under the hood and find some explanation for these type of surprises. And according to the Bureau of Labor Statistics, there is a challenge at the moment with misclassification, where a large group of people are classified as furloughed, meaning that they have a job but they're away from work. And if this group was classified instead as being jobless, then the employment rate would have been closer to 16%. So just keep that in mind for the upcoming numbers as well. However, apart from the miscalculations, the beaten jobs was still a big number. And it is a sign to some analysts that the government's paycheck protection program in the US is starting to pay off, even though it might be just synthetically keeping the numbers high. Now, looking at a rolling economic tracker of the US economy, we can see that things are still very far from rosy despite that big jump in jobs numbers. Yes, we added 2.5 million jobs in May, but that still leaves about 18 million people out of work from the big 20 million drop that we had in April. Now, the stock market didn't shed 1 second to think about the possible ramifications, of course, and after the jobs report, it reached the highest level since the mid-March crash, with the Nasdaq actually printing all-time highs on Friday. Now, the monster rally in equity markets from March has largely been induced by the massive balance sheet expansion by the Federal Reserve, which added more than $3 trillion to their balance sheet in just 3 months. Now, the rally after the stellar jobs report was not surprising in terms of equities, since it did feed into the current V-shaped recovery narrative, but it was interesting because one jobs report isn't really enough to change the economic tide. And more importantly, what happens when the PPP eventually runs out, and what will politicians and central bankers make of these better than expected prints? So if politicians and central bankers fixate on the better than expected data, then the gravy train, so to speak, might start to slow down, which will be a very big negative input for equity markets across the board. And the recent upside in stock markets from better than expected data could reduce the pressure for further fiscal support and might see the Fed also ease back on some of that massive buying spree that they've been busy with. So the big question for this week's video is, what does all of this mean for the US dollar? Now, the answer to this question is twofold. How does the recent events change fiscal and monetary policy stimulus, and how the US economy recovers versus the rest of the globe? So if we are seeing a faster recovery in the US economy, that should be a positive print for the US dollar, and is probably why we saw the US dollar strengthen after the strong NFP print, despite the dollar safe haven appeal, which should have seen dollar weakness on the back of the upside in equities. However, earlier the week, the dollar did come under a lot of pressure as the ECB decided to overdeliver by increasing their PEP QE program to 600 billion euros. So if the recovery is faster in other places, or the expected recovery is faster in other places compared to the US, then that is an environment where the US dollar will continue to lose favor and lose shine in the coming weeks. So turning to the Fed, if they look at the stock market and the better than expected data, which is still in recessionary territory, by the way, just keep that in mind, they might feel less pressured to continue their excessive balance sheet expansion, and that could also start to see some upside for the US dollar. So lesser liquidity could be a better environment for the US dollar, especially if that is coupled with a fast recovery in the US compared to the rest of the world. Now, with a quiet week this week, there's just a couple of things we need to keep in mind for the dollar. First one would be FOMC. Now on Wednesday, we do have the FOMC rate decision, and even though markets aren't really expecting any material changes from the Fed, there are a couple of reasons we need to pay attention to this event. Firstly, this meeting will include the Fed's summary of economic projections, which includes their predictions for important metrics like inflation and growth, and of course the dot plot. Now, by looking at the updated GDP nowcast for the Atlanta Fed, we can see that currently it's tracking a GDP print for Q2 of negative 58%. Now, that is obviously an exacerbated number, with the consensus actually tracking between 20 and 30% negative, but still massive numbers. And there will be no doubt with these type of numbers that the Fed will probably stick to their script by saying that they will continue to use their tools to their fullest until the crisis has passed and the economic recovery is well underway. Now, the economic projections are going to be bleak to say the least, but it will be interesting to hear the Fed's comments from Friday's historic NFP beat. Secondly, we need to pay attention towards yield curve control. Will the Fed have anything to say about the, let's call it, unwelcome jump in bond yields across the curve this week? Now, the recent rise in bond yields will not be something that the Fed will want to see a continuation of, and the reason for that is because higher bond yields means higher borrowing costs across the curve, and that is bad news for the overall economy. So when you want businesses and consumers to spend, you want to assure them that their borrowing costs will remain low. And how does the central bank do that? Well, firstly, they cut short-term interest rates and pledge to keep them low. The Fed has done that. Secondly, they buy government bonds or perform QE to try and artificially keep bond prices elevated and thus synthetically keeping yields suppressed. Now, the Fed has already done that as well. So if all of that is already in place and we suddenly see bond yields cracking out to the upside, it seems like yield curve control is the only way out, so to speak. So with yield curve control, the bank chooses certain durations across the yield curve. So let's say 2 years and 3 years, maybe 5 years, maybe even 10-year bonds. And then the bank sets a yield target for that specific bond yields. Let's say it's 0.25% as an example. So then the bank will buy as much or as little bonds as required to keep the yields for those particular bonds at those desired or targeted levels. So that way, they artificially keep yields low and ensure lower borrowing costs for an extended period of time. So in the current situation, this would make the most sense for the Fed. And even though the markets think that yield curve control is on the cards for later this year, the consensus view is that the recent meeting won't really see that increase in or the announcement of a yield curve control policy, and will rather see the Fed take their time to assess how the market changes over time. Thirdly, forward guidance will be an important point for the market this week, especially as it relates to the bank's current stimulus policies and how they see them developing in line with the overall economic recovery. Then we also need to consider the global economy. If we consider that international trade is increasing, a resumption of international trade is usually a bad sign for the US dollar. On its own, it's not enough to see exacerbated dollar downside, but alongside the unlimited QE program from the Fed and all of the plenty of swap lines, it means there's oversupply of liquidity in terms of dollars, and that can make a lot of room for considerable depreciation once we see a significant uptake in terms of global trade volumes. The growth outlook for the rest of the world still looks dire, just like in the US. But with the US hit slightly later by the virus, some economies have already started to return to some form of normality a little faster compared to the US. We have the EU, the UK, Australia, New Zealand, China. So this alone, of course, isn't a problem. But with internal issues like nationwide riots, etc., the US might take a little bit more time to find that normalcy, so to speak, that they desperately need to try and kickstart the economy. So stimulus in the EU, another big factor for the US dollar. Enough stimulus, both from the fiscal and monetary policy side, is good for reducing risk premiums, as we've seen with the drastic move lower in the BTB bond spread. And as long as investors think that the EU's stimulus measures are enough to see a meaningful recovery, the prospects are looking quite dim for the US dollar. However, on that note, the recovery fund still needs to be approved, and more QE has not been enough to save the EU economy previously. So lots of things to keep in mind for the EU narrative at the moment as well. So looking over to the possible hawkish sentiment shifts for the US dollar, coming back to EU growth prospects, we've seen the Eurozone's pandemic response has been massive so far. Obviously, we have the hopes of the 750 billion euro recovery fund. We also had the additional announcement of additional 600 billion euro QE spent by the ECB on top of the 750 that they've already spent. And the euro saw a massive rally on the back of that, also seeing lots of downside in the dollar. Now, this week, if we do see any further pushback from the frugal four states like Sweden, Denmark, Netherlands, and Austria in terms of the recovery fund deal, that can spark a well-due correction in the short term of that more recent euro strength, and should be positive for the US dollar on balance. So keep that in mind. Looking towards US-China tensions, yes, it is still ongoing. So far, it has been more of a light sparring session between the two countries. But if the gloves comes off, so to speak, and we do get an ugly fight between the two, that of course will see negative risk flows, which should be more supportive for the US dollar as well. And then turning to the Fed, given the type of response seen by Friday's NFP, the better than expected economic recovery narrative is taking hold everywhere. We've seen it even now moving into the bond market. So if that is enough to change the Fed's tone regarding their expectations of the recovery, that also might be a slight positive input for the dollar. Given the possibility, though, of the yield curve control, that would obviously be seen as a negative for the US dollar due to the suppression of any yield advantage attractiveness. But if the market thinks that yield curve control would lead to a possible reduction in the unlimited QE program, that could actually spark some dollar upside as well. So keep that in mind for the Fed meeting. Looking at possible dovish shifts, again, coming back to EU growth prospects, if we do see any of the frugal states like Sweden, Austria, Netherlands, and Denmark coming out this week saying that they are now in line with the deal, they agree to the recovery fund proposals, that can of course see another bout of euro strength and would be a negative input for the dollar. Turning to US-China tensions, the light and timid responses so far between the two countries has caused the markets to look through the recent type of tensions between them. So if we just get any further negative rhetoric without any actual escalation between the two sides, that should on balance be more positive for risk flows and also see more negative outflows from the US dollar. And then turning to the Fed, even though the market is not expecting any fireworks from them, if we see a very bleak summary economic projections, possible yield curve control policy, and on top of that, the bank stressing that massive QE injections are still very urgent, and the market thinks that the balance sheet expansion will still be exacerbated in the next few months, that all should weigh on the US dollar in this week's session. Turning to the possible currencies that we compare against the dollar, if we do see a hawkish tilt on the dollar, a good option against the dollar can be the euro. The euro has arguably benefited the most this last 2 weeks from the dollar weakness, so we can see some tradability in terms of the euro versus the dollar. Also the pound, if Brexit risks are still very much alive and we see negative flows, and then the Aussie if we see a strong risk-off tone at the time. Looking at some possible dovish shifts on the US dollar, good option again there could be to pair the US dollar weakness against the euro, or the Aussie if we see a strong risk on tone in the markets at the time. Remember that these recommendations are based on the current bias for these currencies at the time of writing and can obviously change throughout the week. So make sure to reevaluate whether the short-term sentiment is still valid for these currencies before taking any trades. Looking at the possible economic news to trade into this week, the only significant release for the US dollar this week should be the FOMC meeting on Wednesday, as that is arguably going to be the event that could potentially create the most volatility for the dollar, barring, of course, any further developments with the EU Recovery Fund or Brexit. We won't really be interested in trading the US dollar into the FOMC event this week.